What's the story of Warren Buffett's ground rules? It's all about a book called Warren Buffett's Ground Rules from 2016. This book looks at how Warren Buffett, who's one of the richest people in the world, made a lot of money through investing. The author, Jeremy Miller, studied letters Buffett wrote to his partners in the fund he managed from 1956 to 1970. From these letters, the book talks about the important strategies that regular people can use to make smart choices in the stock market and benefit financially. Who's the author of Warren Buffett's Ground Rules? Jeremy Miller works in New York as an investment analyst for a big mutual fund company. He's been in the financial industry for more than 15 years, doing things like equity sales and research. This book, Warren Buffett's Ground Rules, is his first one. Who's Warren Buffett's Ground Rules for? Anyone fascinated by the dynamics of money and investments, and for those wishing to learn how to maximize their power to their greatest benefit. Why read Warren Buffett's Ground Rules? Ever wished you could make more money without working too hard for it? Well, Warren Buffett, one of the richest people in the world, seems to have mastered the art of getting rich through the stock market. Sounds simple, right? Buy low, sell high. But making money in the stock market isn't as easy as it looks. Fortunately, Buffett shared some secrets. Back in 1956, he started writing reports to his partner about the market, his predictions, and how he invests. These letters, written in a fun and easy-to-understand way over 14 years, hold the keys to starting your own stock market journey. Maybe, if you're consistent and a bit lucky, you could even get rich too. In these insights, you'll find out why France buying the Mona Lisa wasn't a smart money move, how Warren Buffett made his first money deal without even realizing it was a big move, why being patient matters most for anyone who wants to invest. Warren Buffett's Ground Rules Lessons. Keycap 1. Invest. Don't speculate. Want to know Warren Buffett's big secret to his massive wealth of $88.9 billion? It's simple: be patient. Careful investing, not rushing to buy and sell, is what really makes money grow. Here's the deal: some people mix up speculation with investing. Speculators try to guess the market's ups and downs quickly, hoping for fast riches. But investors, like Buffett, study businesses to understand their true worth and then patiently wait. Buffett, a billionaire who keeps things straightforward, learned from his mentor, Ben Graham, that over time, a stock's price matches the business's actual value. So, if a business is worth more than what its stock price shows, patient investors who buy those undervalued stocks can make good money when the market catches up. The trick is not timing the market, but believing it will eventually reflect a business's true worth. This patience leads to compound interest, where your earnings keep earning more. It's like magic. Einstein even called it the eighth wonder of the world. Buffett's favorite example? The French government buying the Mona Lisa. If they'd invested that money instead, they'd have a jaw-dropping amount by now. Exciting, right? In the next parts, you'll learn how to shape your own investing style. Keycap 2. Measure your performance. Successful investors all share a key habit: they measure things a lot. Warren Buffett, even when he was new to investing, aimed to beat the market. But here's the deal: being a successful investor isn't easy. To be like Buffett, you've got to handle stress and keep a cool head. It's like checking your bank balance after a big weekend. It can be nerve-wracking, but it's essential. For investors, measuring and analyzing regularly, even when things aren't great, is the only way to succeed. Here's the truth: most people can't outsmart the market. Buffett did it by a small margin, but thanks to compound interest, even a bit above the market can lead to big financial gains. How do you measure compulsively? Keep an eye on your investments every day, compare them to how they've done before, and stay patient during tough times. It takes effort and honesty. You've got to know when to keep going and when to stop. It's not just about past performance. Compare your results to the overall market. Even if the market's down and you're just a bit less down, that's still a win. Good news: today, it's easier to invest in the stock market, thanks to something called index funds. They spread your money across lots of companies, so your gains and losses match the overall market. Buffett suggests buying index funds if you don't have the time for active investing. Otherwise, keep measuring to know how you're doing. Keycap 3, buy cheap when young. Once you've nailed down measuring your investments, it's time to shape your own investing style. Remember, each investor is different. Your style should match who you are, what you aim for, and how much you have to invest. For instance, if you're into farming, it's smarter to invest in what you know rather than something completely new. Here's a tip for new investors: having less money can be an advantage. You can invest in smaller companies not listed on the stock exchange, where even small gains mean a lot. But when you've got more money to manage, you need bigger deals to make a difference. When Buffett started, he focused on undervalued companies he called generals. These were okay businesses, but priced lower than they should be. He held on to these investments for a long time, and it paid off. He also liked companies worth more when shut down than when operating. If things went south, he could close the business without losing much. These were called net-nets. These cheap investments aren't glamorous. Buffett humorously called them cigar butts. But surprisingly, they gave him the best returns in the early days. As Buffett got better, he shifted to buying great businesses at fair prices. He cared more about a company's quality and if it could keep making money sustainably. As you gain experience, you might want to get more involved in managing your investments. Buffett has more guidelines for that, and we'll explore those next. Keycap 4, take risks when you have an edge. When Warren Buffett was a kid, he bought Coca-Cola for 25 cents and sold it for a nickel each to his friends. Sometimes it worked well, sometimes not. If his friends weren't thirsty, he'd have extra bottles. Here's the point: taking more risks in markets you know well can mean bigger rewards. Without realizing it, Buffett was doing his first arbitrage with Coca-Cola. He played with price differences between buying at the store and selling to his pals. Arbitrage is about betting on what you think a company will be worth soon. It can give good returns, but you've got to know the businesses and their markets really well. Buffett was into merger arbitrage back then. He'd buy stock in a company, betting it would be worth more after merging with another. It was tempting, but risky. Average investors should avoid it unless they're experts in that field. Experienced investors who don't want that risk might go for controls. It's when you buy enough of a company's stock to have a say in how it's run. But controls can lead to clashes between owners and new managers, which got messy for Buffett. So, he stopped. His investing principles stayed solid, though. In the next part, we'll see why Buffett's steady approach led to his incredible success. Keycap 5, stick to your strategy. Following the crowd might be smart sometimes, but not in investing. To succeed, you've got to train yourself to go against the crowd. Buffett always stuck to his principles, even when the stock market seemed too high in 1956. While others made big money with risky moves, Buffett stayed cautious. He knew a market correction was coming, even if he didn't know when. There was this hotshot investor, Jerry Tsai, who did the opposite of Buffett. Tsai made a lot of money by constantly buying and selling stocks, riding market swings. But Buffett believed Tsai's method wouldn't last. In 1966, when the market was at its peak, Buffett changed his game. He stopped taking new partners, lowered his goals, and stayed cautious. His fund did great, but he knew when to step back. Tsai saw trouble coming too and sold his fund in 1968. Then, in the early 1970s, the market crashed big time. Buffett was safe because he'd taken his money out. But Tsai's investors lost 90%. Buffett's lesson? Stick to your beliefs, be patient, and when the right chance shows up, take a bold move. That's a recipe for success, not just in investing. Warren Buffett's Ground Rules Review. Making money in the stock market isn't impossible, it's achievable for anyone. But it's no quick win and requires serious dedication. Following Buffett's advice of measuring carefully, staying consistent, and above all, being patient, can pave the way to becoming a successful investor. Warren Buffett's Ground Rules Quotes. Warren Buffett quotes, "Price is what you pay." Value is what you get. Honesty is a very expensive gift, don't expect it from cheap people. Somebody once said that in looking for people to hire, you look for 3 qualities. I insist on a lot of time being spent, almost every day, to just sit and think. Someone sitting in the shade today because someone planted a tree a long time ago. Be fearful when others are greedy and greedy when others are fearful. If you're in the luckiest 1% of humanity, you owe it to the rest of humanity. The most important thing to do if you find yourself in a hole is to stop digging. Risk comes from not knowing what you're doing. The difference between successful people and really successful people is, no matter how great the talent or efforts, some things just take time.